You've got LLCs, rental properties, maybe even a side business, yet every asset feels like another lawsuit or a tax bill waiting to strike. In the next few minutes, I'm going to show you how a single family holding company can corral all those moving parts and wall off liabilities without adding chaos to your life. Because the moment one tenant slips or the creditor wins, everything from your consulting income to your kid's inheritance can vanish if it isn't shielded the right way. Hi, I'm Talai, a trust and asset protection attorney and founder of Talai Law Offices. I recently started making videos on social media with the goal of providing educational content that helps individuals and families make smarter decisions about estate planning, asset protection planning, and preserving generational wealth. I'm passionate about helping clients create estate plans that protect their legacy, and it's not just there to distribute their assets. Estate planning is full of legal nuances that can impact both your family and your financial future. That is why I like to invite you to join my free webinar, Avoiding 5 Biggest Estate Planning Mistakes. You can register at talailaw.com. That's TALAI law.com under the event page, or simply use the link in the description below. All right, so let's first discuss exactly what a family holding company actually is. It is essentially a business entity that exists to own and manage other assets or companies on behalf of your family. Think of it as an umbrella entity that holds your family's various investments, real estate properties through subsidiary entities, business interests, and other valuable assets under one roof. Now, it is important to clarify something about the name itself. Many times, this type of entity is referred to as Family Limited Partnership, FLP. However, the reality is that no state actually has a set filing specifically called Family Limited Partnership. It's really a limited partnership that gets filed, but the term FLP has been marketed for so long that it has become the commonly used term for its sophisticated wealth management structure. So the holding company itself doesn't typically engage into day-to-day business activities. Instead, it serves as a parent entity that owns membership interest in operating companies, hold interest in other entities that hold title to real estate, manage investment portfolio, and coordinates the overall financial strategy for your family's wealth. Most family holding companies are structured as either a limited liability company, LLCs, or limited partnership, LPs, depending on your specific goals and tax situations. The key difference here is that unlike your operating business that generates income through services or products that it sells, the holding company generates income primarily through distributions, rental income, capital gains, and other passive investment return from the asset it actually owns. Wealthy families have been using holding companies for decades because they provide sophisticated level of asset protection and tax planning that you simply cannot achieve by holding everything under your personal name. When you own multiple businesses, investment properties, or substantial investment portfolios directly, you're essentially putting all your eggs in one basket from a liability perspective. Let me give you an example. Let's say you have 3 rental properties and you hold them under your personal name. A horrible idea. A successful consulting business, and a significant stock portfolio. If someone sues you personally over an accident related to one of your properties, they can potentially reach all of your assets, including your business, your other properties, and your investment accounts. But if those assets are owned by a properly structured holding company with appropriate subsidiary entities, the liability exposure from one asset won't automatically jeopardize all your other assets. The holding company structure also provides tremendous flexibility for estate planning. Rather than transferring individual assets to your children or beneficiaries, you can transfer partnership interest or membership interest in the holding company to that person, or most likely to the trust for them. This makes succession planning much cleaner and often more tax efficient. From an asset protection standpoint, a family holding company creates what we call layered protection under California law. When you structure things properly, creditors who obtain a judgment against you personally face significant hurdles in reaching assets held by the company. California Corporation Code 17705.03 provides what's known as charging order protection for LLC's interest. This means that even if a creditor gets a judgment against you personally, they generally cannot force the LLC to distribute assets to satisfy that judgment. Instead, they can obtain a charging order which entitles them to receive any distributions that would otherwise go to you. But they cannot compel those distributions to be made. In limited cases, California law does allow foreclosures on the interest, but even then, the buyer receives only an economic interest, not management and control. Obviously, this depends on how you set up the entity and the operating agreement. Those all matter as well. This protection becomes even more powerful when you layer multiple entities. For example, your holding company can own the membership interest in separate LLCs, each holding a single property or business operations. This creates multiple barriers between potential creditors and your core asset. In California, single member LLCs don't always have the strongest asset protection laws for charging orders, and foreclosure on the interest is also possible. While a California limited partnership inherently has at least two partners, which can improve charging order protection, and even more protective strategies often to use a Wyoming holding LLC. Wyoming offers strong asset protection statutes, including charger order protection for single member LLCs, and it has no foreclosure remedy for creditors. In this structure, each property is placed in an LLC formed in the state where the property is located. For example, if you have a property in California, we would form a California LLC. If it's in Texas, we would do a Texas LLC. Those property owning LLCs are then owned by your Wyoming holding LLC. This way, you benefit from Wyoming superior charging order protection at the holding company level while maintaining compliance with each property's local requirements. I've seen this structure save clients millions of dollars in litigation. Let's talk about tax benefit. The tax benefit of a family holding company can be substantial, particularly for California residents who face some of the highest state tax rates in the country. When structured properly, a holding company can provide significant opportunities for income shifting and tax deferral. For instance, if you have adult children who are in lower tax brackets, you can make them partners, limited partners, or interest holders in the holding company and shift income-producing assets into the entity. The holding company can then make distributions to the children at their lower tax rate rather than having all the income flow through to you at your higher tax rate. Family holding companies also provide excellent opportunities for state and gift tax planning. Under current federal law, you can gift up to $13,990,000 per person during your lifetime in 2025 without triggering any federal gift taxes. Beginning January 1st, 2026, this exemption will increase permanently to $15 million per person, and it's indexed annually for inflation. Through techniques such as grantor retained annuity trust or sales to intentionally defective grantor trust, that's actually a good trust, you can leverage these exemptions to transfer significantly more wealth to your children or other beneficiaries using a holding company structure. While California does not impose its own state taxes, I think they completely just forgot about this thing. It does have some of the highest income tax rates in the nation, and a properly structured holding company can help minimize impact of these taxes and preserve your family's wealth for future generations. One of the other most powerful aspects of a family holding company is how it simplifies estate planning and business succession planning. Instead of having to transfer dozens of individual assets, properties, and accounts to your beneficiaries, you can transfer partnership interest or membership interest in the holding company to them. And again, I'm an estate planning attorney, so I would always recommend to you to make sure any transfer you make to your kids, make sure it's done within a proper trust planning. This approach provides several advantages. First, it's much cleaner administratively rather than dealing with title transfer for multiple properties, account transfer for various investment accounts, and ownership changes for different business interests. You're dealing with a single entity transfer. Second, it provides much more flexibility in how you distribute your wealth. You can create different classes of partnership interests or membership interests with different voting rights, distribution preferences, and transfer restrictions. This allows you to maintain control during your life while gradually transferring economic benefits to your children. For example, if you create an LLC that has voting and non-voting interests, and if you slowly start to transfer and gift the non-voting interest in that particular LLC into a trust for the benefit of your child, you can start doing some planning and start gifting away assets where the value is lower now as compared to when, the time comes and unfortunately you have passed away. However, even though you're transferring interest, the fact that you're transferring the non-voting interest of the LLC or the limited partner interest of an LP, you still can stay in control, make the major decisions, and have your say as far as how things are supposed to be ran, and at the same time have an estate plan in place. Third, it can provide significant valuation discount for state and gift tax purposes. When you transfer interest in a holding company rather than the underlying assets directly, you can often claim discounts for lack of marketability, minority interest positions. These discounts can reduce the taxable value of your gifts and bequests by 20 to 40%, sometimes even more. A family holding company typically makes sense when you have multiple income-producing assets, substantial investment portfolio, or a complex business interest that would benefit from coordinated management and protection. The structure is particularly valuable if you are involved with real estate investments, have substantial business interests, maintain large investment portfolio, or expect to receive a significant inheritance or liquidity event in the future. It's also beneficial if you have concerns about professional liability exposure or if you're in a high-risk profession. However, a holding company isn't right for everyone. If your wealth is primarily in your primary residence, retirement accounts, the added complexity and the cost may not justify it. Similarly, if you have just started to build wealth and don't yet have multiple significant assets, you might be better served with a simpler structure initially. If you're considering a family holding company, the most important thing is to work with experienced professionals who understand both the legal side and the tax implications. The structure needs to be designed specifically for your situation, taking into account your assets, your family dynamic, your tax situation, and your long-term goals. I've seen way too many cases where people set up these sort of entities without proper planning, only to discover later that they have created more problems than they have solved. The key is to approach the strategy with clear understanding of what you're trying to accomplish and how the holding company fits into your overall asset protection and estate planning strategy. What we've covered today gives you, I'm hoping, a foundation for understanding family holding companies and whether they might make sense for your situation. The key takeaway is that these structures can provide powerful asset protection and tax planning benefits, but they require careful planning and ongoing professional guidance to be effective. Here's what's crucial. Even if you decide a holding company is right for you, there are specific legal mistakes that can completely undermine your asset protection strategies. These mistakes are incredibly common, especially among real estate investors, and they can leave you completely exposed even when you think you're protected. That is exactly what I'm covering in my next video. 3 legal mistakes that can sink your rental property portfolio. I'm going to walk you through the 3 most dangerous worst mistakes I see investors make, including one that can actually make your liability exposure worse than what it was before. If you own rental properties or if you're thinking about investing in real estate, this is information you absolutely need to know to protect yourself. I will see you over there.